I'm good. We've been waiting for you.
All right. Sorry if I'm 1 minute late.
Yeah, no problem. No problem. It's understandable. I think we would have to go straight to the point, and the other community members will join in as we keep going.
Sure.
Yes. So currently we have Don Pine on there. We have Kofi Samoa here. A few of them will be joining in later. But I would want to just do a little introduction for you to take over.
Perfect. Let's do
Yeah.
it.
Yeah, so Kofi, please mute your mic. Okay, let me mute that. Yes. So, yes, we are all once again welcome to FTGFx Lounge. FTGFx is the trade name for Forex trading in Ghana. It's an online trading platform that provides the necessary education for traders to understand how the Forex market works, how to trade easily, safely, and profitably. We have the FTGFS Lounge as a platform where traders, both amateur, professional traders, do come in, share their trading experiences with us, for us to also get abreast with whatever is going on in the market and also learn from that. Because the popular saying goes like, experience is the best teacher. We have the Marshall Trader in the house. This is the third. This is the third. This is the third podcast that we are having with him. But the ones that I did earlier, it was just me and him. But this time around, we have few members in the house to also tap into the knowledge and all of that. So I wouldn't want to waste much of our time. He's going to he's going to take us through what forex trading risk management is about. It's a broad topic, but he's going to share with us what a newbie or a new trader should know, the risk involved and how to manage it. When choosing a broker, the risk involved and how to manage it. When trading in the markets, the risk involved and how to manage it. So I wouldn't want to waste much of our time. I'll hand it over to him for him to introduce himself and then take us through these few topics. And maybe in the next episode, we'll continue with the risk management. So, Marshall Trader, I'm handing over to you to help us understand these topics.
All right. Perfect. So, am I starting directly or somebody's going to introduce himself?
Yeah, you are starting. Maybe after you are done after you are done, then we would ask if there are questions they come through with it.
Okay.
Yeah.
Perfect. So, what can I say about risk management? Risk management, it's a topic that's been coming often, and it's very complex, but at the same time, it's very simple. I've been dealing with risk management from a long time, since my first trading account, dealing with losses with burning accounts, then dealing with profits, and then with losses, burning accounts, and so on and so forth. So regarding beginners, one thing that I want to say is that, once again, I said it in the past episodes, the issue will often not be risk management, because you will often find that most of traders know that there is a risk involved. So they know that they don't want to lose 100% of their capital or 50% in one day. But once again, this is linked to the topic of discipline. So I'm not going to go too much into this topic because we spoke last time about it. But you can have the best risk management in the world without any discipline. It will not be worth nothing. So first of all, people need to work on their discipline. And why you should work on your discipline is because there is a fundamental thing that I want to say, because I'm very excited always. We spoke also about different topics. I'm always very excited to speak to African brothers, because you have to think of the different traders that they are in the world. Mm-hmm. Imagine somebody starting at a certain age with a capital of $100,000, and somebody starting as a beginner or as a student or with a more modest background, let's say starting with $1,000. Then the risk management is totally different. Okay. Why? Because if you start with a capital of 100, 200 or $500,000 and you say, look, this is my savings and I'm ready to risk 30% of it, then the risk management needs to be very strict. But once you start with a small amount, your first $100, $200, of course, you can be a little bit more loose, because This is not like, let's say, a very strong capital that you are trying to develop. You're just trying to learn Forex. And why I'm saying that? Why I'm saying that you should be a little bit loose and you should get yourself to learn and develop your psychology and your experience. Because today with you, I want to reveal very important secrets that is not being shared so much in the markets. It's kept secrets from people, but I am here to reveal it to everybody who is listening here.
Right.
If the secret is the following: if you think that you will make, everybody who's joining Forex is doing it because, or trading in general, stocks, indices, whatever, is doing it at the end to make money. If you believe that you will become rich, wealthy, successful, millionaire, whatever you want to call it, to your standards, by continuously trading your own money, then you got it all wrong. You have it all wrong. Because everybody's looking at those success stories that I will start with $100, with $1,000, I will learn, and then one day it's going to become 10 and 100 and million. This is very, very little. It takes a lot of sacrifice, and you don't see the vast amount of traders that give up along the way. Throughout my journey, I met many, many traders, many countless people that I've met, people better than me, worse than me. Many of them gave up. Some of them didn't manage to reach their objective. This is not an easy way. So you cannot see as somebody being successful or making money and say, I want to be like him. This is very difficult. But one of the way for which absolutely everybody is making a living and being successful and reaching all the objectives that they want to reach is by becoming fund managers, wealth managers, trading other people's funds. So I want to say that to all my people all over the world, especially all the brothers in Africa, that they are thinking, I want to trade my money. Your objective is not to make money for yourself. Your objective is to make money for others. And that's why risk management is very difficult. That's why risk management is very, very serious. Because if you play with your money and you start with 1,000 and you burn it, and you turn 1,000 and 10,000 and you burn it, whatever you want to learn, and you make a little bit of money, at the end of the day, it's your money. But you will never reach a level that you will be trading millions and tens of millions in your own money. The psychology behind it, the risk behind it, all the discipline behind it, it's so strong that it's almost impossible to reach. Because the issue of the risk management is that, trading with a small amount is not the same as trading with a big amount. So let's say if everybody around you, your community, your parents, your brothers and sisters, whatever, they are living with $1,000 amount, $2,000, $5,000, $10,000. And this is not only in Africa, because in France, in many developed countries, this is the same. This is the same thing. You will see people around you living with, and you think that you're going to be trading with a 500,000 account and making 20K in a day and risking 30K in a day. The whole psychology behind it is so strong. It's so strong. But the objective that you have to do is being extremely strict in your risk management from the beginning, keeping those strict rules that I can go through. I can give example, of course, because I even coded them and I have a robot about it. So we're going to go through this and I will speak facts. But the most important is to develop this consistency, not for your own profit, so that your strategy can be seen by others, can be appreciated with respectable drawdown, with consistent profit, with consistent risk-reward ratio. And there is so much more people that they have so much investment to give, and they are looking for traders like you, and you will be so much more comfortable trading other people's fund and making a performance out of it and a living out of it than always chasing to develop your own funds. So this is my point.
Right. So this has got to do with risk management, how newbies or people trying to enter into forex trading business should look at it. Like, that's how they should look at the whole business. And per what you are saying, it means that it's dependent on the capital you start with at some point, or as a newbie. So for instance, if I have maybe let's say $100 that I want to build or grow the account to become maybe a billionaire or whatever, per what you are saying, maybe it is possible, but it's not easy, or it's not even possible at all.
Yeah, it's not impossible. Nothing is impossible.
Right.
But it's definitely not going to be easy. How many times you will have to fail until you succeed? What I mean is that if you start with $100, nobody's going to want to invest hundreds of thousands by looking at your strategy of $100. So if you want to make money with your $100, of course you are ready to risk more, to risk, because you need to open volume and the capital is very low, or $1,000. So you are ready to risk 50% of it, or you are ready to fully risk it to the point that I have this $1,000, I will trade the maximum of it, take the full risk, and try to turn it into 5,000 or 10,000 or above. But as soon as you reach to a certain level that nobody can tell you that level, you will know about it, because $10,000 for somebody is nothing, but for somebody else it means the world.
It means the world.
Exactly. So when the amount started to grow, and you can see your psychology being affected, it's time to really focus more strictly on your risk management, saying, now I have $10,000. I don't want to play with it. I don't want to lose 50% of it in one day. So now I need to work on my discipline and say, I can have my daily loss, maximum daily loss of 1%. I can have my daily risk per position, for example, of 0.1%.
Yeah.
I can try to fix my risk reward ratio of 2, meaning I'm ready to risk 1 and make 2. And in this case, now you are developing the plan and you put in your stop loss and your take profit at a level that is allowing you to not go bigger than the risk, your daily risk and your position risk and your monthly risk.
Yeah, for which I agree with you perfectly. But like I said, we would open the floor for the community members to also ask questions. But since this being our first time for risk management, I would want us to touch on the point. So for the first point, which is how a newbie should see the market, for you think that it should be more on capital, like it depends more on the capital. They should look at the amounts they would want to start trading with, not maybe in the hundreds, because you think, and practically it might end up losing the money at some point. That's a summary of that point, I guess.
Yeah, in a much shorter version, what I want to say is that if you are really a newbie, first of all, you have to try to make some performance. It's good if you have a very low drawdown and you are really strict on your risk management and you have your stop losses and your daily risk, but your performance is very low. Then you will be wasting time. If you have your $100 and then at the end of the year you still have $105 and you made 5% and you are very strict, nobody will care about your strategy to invest, because that's only $100 and you have not made any money. So you have the choice to try to focus on the performance and be a little bit more loose on the risk, saying, I have only $1,000 or $500. I'm ready to risk 50% of it or everything. But you need to start making performance. The objective is that to try to grow this account. And once again, the risk management depends on the target of each trader. For one trader, if he wants to make 20% a year, then you can be very strict on your risk management. But most of the traders are not like that. Usually, if you have $1,000, your dream is to make a lot of money out of it. So you cannot be extremely strict with your risk management and grow accounts very fast like I did or like successful traders did. So that's my point.
Right. I agree with you perfectly. I would like us to look at the second point, where in choosing a forex broker, because before you can trade, you need to sign up with a forex broker. But we know there are scammers online as well. So what are the risks involved in choosing a forex broker, and how should newbies or even traders handle that or manage that risk?
Okay. So regarding choosing the forex broker, I would say the newbie, you don't have that much risk on that part, because the bad forex broker will show their weaknesses for much higher amount or much difficult strategies. What I want to say by that is that, first of all, there are two types of brokers. There are brokers who are more market makers, and there are brokers who are more STP. The STP broker will send all the trades to the market. The market makers will keep the risk in-house. But if you trade with huge amounts, the market maker also will send your trend to the market and act as STP. So in such case, the risk is not such. Then you have brokers that maybe they will offer you a better execution execution. They will offer you lower spreads. They will offer you better leverage. But some brokers might reduce it just before the weekend on Friday. So if you have positions open on Friday and your leverage is reduced, suddenly your risk is increased. There are some brokers that the execution is very important, especially when you start to trade big position. Your stop loss, your take profits are going to be hit, but the execution will be bad, so you will lose more, or you will make less profit, or you will have slippage. So it's important to experience that. But I would say in general, you have Trustpilot, you have all those review websites. Overall, if a broker has a lot of review, has regulations, of course, it's important for the safety of your capital in the future that you have bigger funds. It's important for your funds to be in safe hands. So if the broker is regulated, if the broker is offering you all the standard platform, if you are not being called by the broker by some cheap sales telling you deposit more money, you will make profit. If the broker is clean on that, you don't have any worries to do. And don't worry so much about this. Once your capital will grow and your experience will grow, don't keep your eggs all in one basket. It's very important. You have to have your funds in different brokers, and then you will start to experience the difference. Like with this one, my position didn't get executed correctly. With this one, there was some slippage. With this one, the leverage was being changed. And slowly, you will get to find the perfect broker for you. But as a beginner, you shouldn't worry so much about it.
Okay. So if I get you perfectly, then in choosing a broker, maybe the first thing you need to look at is the protection of your funds, and that's where regulatory. You need to ensure that the forex broker is being regulated by a regulatory body first,
100%.
Right? And then maybe after that, you can also experiment with different brokers to see the spread differences, the slippage, execution times, and all of that. Okay. All right. Sure. Thanks. And I would want us to look at the last one before our community members come in. The last one is now we know how the newbies should look at the forex market, or how they should approach it. Now we have a fair idea of how we should also look at brokers and manage the risk there. Let's say now we've funded our accounts. We are now trading. What are the risks we are exposed to in the market, and then how should we manage it?
Okay. So now you're experienced. You're trading your own funds or you're trading other people's funds. There are a lot of different risks that we are talking about. So first of all, you have all the risk related to the technology that you have to protect yourself. I'm going to go through it, but when you have experience, you will see all those risks starting to attack you sometimes, and you will start to defend yourself by finding solution. Let me give you one of them. Now you have big funds. You're trading $100,000. And suddenly your connection is lost. For example, you were using an expert advisor to automatically close your position at a certain profit or loss. So to avoid all this risk related to technology, you will need to, for example, use a VPS. Like this, you install your trading account and your trading platform on a VPS, and even if your connection is lost, even if there is a power cut of electricity, your VPS will still be working 24/7, and your account will be protected. Now there is also all the risk related to what I said, for example, execution, change on leverage. With this one, you need to be a little bit conservative. You can never be that much aggressive that you have so much position or so much margin usage that because I speak to some traders and they're like, I had some really good performance, but then the broker reduced my leverage and I got stopped out. So there is no chance that you have to be so aggressive as an experienced trader that the broker will change the leverage from 500 to 200 and all your position are closed. So you need to start. When you trade with bigger amount, you cannot be that aggressive. So you should, for example, stay even lower than 1 to 100. The bigger the amount, maybe 1 to 10. When the amount start to increase, I will reduce my leverage even around 1 to 10. It's very important because if you have, for example, a weekend gap, now if you trade, I'm going to go to this point later. So if you have a weekend gap, if you have news that suddenly there is a strong volatility, your capital is going to be protected. Then there is a risk based on the instruments. You have to diversify your portfolio. Why? Because let's say $1 dollar is quite safe, but you're trading gold. I don't know if you remember old enough, because I've been through this thing and I was trading live when it happened, when there was the Swiss crash.
No,
when there was a Swiss franc.
I wasn't in there. I think it was somewhere 2015, I guess.
To be honest, I'm trying to remember the date, because it's been a while. I thought it was a little bit later. I don't remember the date, but whatever. I had some position open, many position, and I'm trading baskets. I'm always opening a lot of position. On that day, I have to say, thank God, I was not opening some Euro Swiss or some dollar Swiss, because some broker blew up and some accounts blew up. And what happened is that if you're on the right side and you think you're going to change your account from 10,000 to 1 million, the broker will never pay you, because this is a flash crash. It's like a glitch in the Forex world, and you're not going to be paid. But if you blow up your account, of course, they're not going to reimburse you. So I know so many people that they blew up their account with a 0.01 trade on the dollar Swiss, for example.
Wow.
Trading the crypto, as you can see, with just recently this weekend, you see what's happening with USDC. I've always been very cautious with the crypto. I just very recently, because I have so many people asking me, and some fund managers are asking me as well, can you adapt your strategy to Bitcoin, for example, and to other cryptos, to Ethereum, to Ripple? I say, yes, I can, but I don't put my own capital, and I don't trust it 100%. My strategy works with correlation. Bitcoin is semi-correlated to other cryptos and a bit correlated to dollar, but it can move on its own and it can crash on its own. And then you can see what's happening on Bitcoin. That's why there was also the crash when the crude oil became negative. That was just a couple of years ago. So you have to experience that, and you have to be ready for the next crash, and hopefully be diversified enough, be protected enough with lower leverage, not to, when you trade different accounts under different brokers and trading different instruments, hopefully, if you are the unluckiest enough that one of those days this will happen, it might crash your account, but it will be only one of 5 accounts, and hopefully the rest is protected and you can recover. But if you are putting all your eggs in one basket, then this is the end for you, unfortunately.
Yeah, I've experienced that a lot of times, and I can relate to whatever you are saying now. But what's your take on position sizing and stop loss?
Okay, this one is the simplest, and that's why I've created a robot, and I didn't want to be bothered by it, because knowing where I should put my stop loss, how much, now I enter my parameters of how much I'm ready to lose on that day, how much I'm ready to lose on the position, and then I trade, and the robot will set up everything itself instead of maximum loss and profit and the volume that I should open. So this I code it myself. If you're not to that stage left, you should just have very simple rules of maximum exposure, meaning per my balance, maximum volume I should open, maximum daily loss, because there is no way you can grow your capital if you're ready to lose 30% in one day. It will be so difficult to get back this loss, and your maximum drawdown for your account. So if you apply just those 3 rules, no more, the maximum volume I should open, meaning the maximum margin or maximum leverage I will apply, my maximum daily loss and my maximum drawdown in general, like this, you are already on the right path. What I see is that many people would say, yes, I'm ready to lose 50% of my account, I want to go aggressive. Yes, but they will touch it in 2 days. This is not acceptable. I'm going to give you an example. I have an account of $1,000. Maximum volume I will open is 0.5. It can be 1 position, it can be 5 position of 0.1, doesn't matter. Maximum volume at any time, 0.5. Maximum daily loss, 3%. Maximum drawdown, 30%. This is an example that is quite conservative. If you can stick to that and be able to trade consistently within 3 months, within 6 months, you have a successful strategy. No matter how much profit you made, but at least you stick to those rules. Now you have a small capital, $100. You can say maximum volume per day, 0.05 or 0.1 lot. Maximum daily loss, 5%. Maximum drawdown, 50%. That is already aggressive. but trade freely without those rules of maximum volume. Because what is the number one reason why traders lose? There is only one, and this is the biggest by far: overexposure by scaling on their losing position. This is the number one reason, and we all went through that. I'm losing, I will open another position, but it will recover. The market goes against me, I open another position, I will recover. There is no maximum daily loss, there is no maximum drawdown, and there is no maximum volume. I continue opening as long as the market goes against me, and I'm just digging my own grave until I reach the stop out.
I can relate to this a lot. So, what you are saying, it means when you start trading, okay, the best way to manage your risk has got to do with you developing a trading plan. What you are saying, so that you can stick to that, or that will be serve as a guide in order for you not to do anything aside your trading plan. Exactly, you're right. So, like I said, this is our first meeting. This is my third meeting with you, and there's your first meeting with the community members, and I just wanted us to touch on risk management, and maybe as time goes on, we'll meet again and then continue from there. So I would maybe at this point, I don't know if you'd want to add some more points to it, or I should open the floor for questions.
No, please open. I want to speak to the people. We are doing that for the people, for them to learn, for them to participate. So I'm very happy to have people on board.
Okay, all right, sure. So the floor is open now. If you have a question, you can on your mic and then come through with a question, or maybe you can just raise your hand for me to on your mic for you to come in. I have a question from Mustafa. So his question is, how will you know if a broker is regulated?
How you know? It's very simple. They have to write it on their website, and then you have to go and verify it. So let's say you have all the major regulation. You have the London regulation, that is FCA. You have the Australian regulation, that is ASIC. You have the European regulation, that is CISEC of Cyprus, one of those major regulations. And then you have more offshore regulations that they are less powerful, but still important. Why? Because all the major regulations of London, of Australia, of whatever, Japan, of Europe, they are limiting the leverage, they are limiting the conditions a lot. Okay. So much so that now only professional traders are allowed to trade on the bigger leverage and stuff like that. So many brokers are opening offshore regulation, like Seychelles, like Mauritius, like Vanuatu, like Bermuda. It's not a bad thing. It's just that they don't have the choice. Otherwise, they will not be able to offer higher leverage or many instruments. And once you see on the website, you have to be very careful. Some website will not write anything in the bottom. They will say broker ABCD is registered, whatever, under the brand. It's not written anything about regulation. You have to be cautious. Otherwise, it will say this broker is regulated with the number 123. So if it's regulated by FCA, you have to go to the FCA website. You have to type the name of this company, and you will see the confirmation that this broker is fully regulated.
I think I can also share an experience. I once did that with I can mention the VT markets, and they had on their website that they are being regulated by ASIC. The Australian SEC, and then one in South Africa. So the ASIC was registered, which I had the documents, I verified myself. But the one that they said was registered in South Africa, I checked from that regulatory body, and they didn't have their name there. So like you said, it can be tricky at some points. They can have it one registered with one regulatory body, and they can just use another name for another regulatory body. So you have to do the due diligence and check from all websites or all regulatory bodies, I think.
I will just add quickly that, look, you go to Trustpilot, you see that the broker has a lot of reviews.
Okay.
If you
Trust
see it on the big
pilots.
websites like FX Street, all of these things, start with one of the big brokers. Don't find a very small broker that is not known in the world, that not many people tried it, or it's very local. Try a good broker that has a good reputation, that has a lot of reviews on Trustpilot. When you go to Trustpilot, you will see a lot of 5-star review. Click only on the 1 star to see the worst review. And if everybody is saying, no, it's a scam, I never saw my money, stay away from this broker. But if overall the reviews are good, you can trust this broker. If they have hundreds of good reviews, then already that's a good starting point.
Yeah. Okay. Thanks for that. The next question is from Don Pine. So he said, when you are in a position, is it good to look for another position within the current position? If the position is going against you,
yeah.
His
The
question
answer,
the
answer is no. No matter what you will say, the answer is no. Once you open the position, you cannot, you shouldn't trade more, because this is not according to your plan. If you wanted to open one lot at the beginning, you should have opened one lot. But if you open one lot and now you open another one because it went against you, or it's going in your favor and you think you will make more profit, and you open another position, already you are messing your plan. So you should know the volume that you will trade. As we say, you have to plan your trade, and then you have to trade your plan. So if I'm planning to open this position, once I open it, I don't touch it until it touch my stop loss or take profit.
Okay.
But you shouldn't play with your position, because it's going to lead to over trading, and then you don't realize, but you're not following your plan anymore.
Okay. So then basically the person at don't pine. So just saying or rephrasing what Marshall Trader said, I think you should have a trading plan and stick to it, I guess.
Yeah.
Right. So then the other question is from Kofi Asamoah. So his question is, how isn't it possible to use the strategy that you use to trade your own money? To trade your own money, trade big money. How is
my strategy?
Yeah. Why? Let me take it again. I guess he said, how isn't it possible to use the strategy that you use to trade your own money, trade big money?
I understand. It's a very good point. Yeah. Meaning that if I have a good strategy, why I cannot use my strategy to trade a lot of money?
Yeah.
Because I spoke about funds and trade other people's funds. I am telling you, because you will suffer. It is possible, but you will suffer big time. No matter, I have been 14, 15 years in the market. I am still shaking if I trade my own funds with hundreds of thousands. And I will tell you why. Because it represents a lot of money. If I own, we are all human beings, we all have aspirations. Maybe you are living with your parents, or maybe you already have your own apartment, you already have your own house. Once you start making money, all this profit that you make has a direct impact on how you're thinking of what this money will make. So let's say you have a $100,000 apartment, and you think you will be trading $100,000 account and losing 20K in one day, for example, or using 5K or making 5K. Your psychology is going to be so affected that it's like starting again from the beginning. This is the issue. You think that you have your house is paid and you have your cars, whatever. You're going to be trading with a $1 million account, and you're going to be losing 50K of your own money, 50K on your own. Once you lose, let's say you have a normal strategy, and many times you hit 5% drawdown, many times, and you always recovered and everything went well. And now you are trading with a $1 million. How much is 5% out of 1 million? That's 50,000. 50,000, that's a huge slap. So maybe this time you're going to still lose 5%, but you will not think of 5%. You will think, oh, damn, I lost $50,000 in one day. That's a disaster. And you will think of recovering 50,000. Once you reach to a certain level and you're trading other people's fund, and those people are putting millions and their trust on you, first of all, because it's not your money, you are very serious, you are very conscientious, because you don't want to play with other people's fund. And second of all, it helps you to focus more. At least it did for me. I am 1,000% more comfortable trading 10 million out of other people's money and still making a very good performance fee, rather than trading 1 million of my own funds. And I'm going to tell you this secret, because one of my biggest trader, but I don't have his agreement, so I don't want to reveal his name. It's one of the biggest trader in the world that I met. If I will ask him, Next time I meet him, I will ask him if I can reveal his name. I don't think he will have a problem, but I don't want to. And he's African also, so I think you guys will enjoy it.
Okay.
And one of the biggest trader in the world, he revealed me this secret. I met him, and he told me, "Look," but at the end he said it to a lot of people. He didn't say this secret only to me, so this is not an issue.
Right.
He has traded huge funds, billions of dollars. Even this is not my level. Billions of dollars of funds all over the world, North America, Africa, Dubai, Middle East. And he said, "You know what? My own fund, I never traded big money with my own fund, not even tens of thousands of dollars.
Okay.
It was always other people's fund. Because if you have to trade 100,000 of your own fund or trade or have a really good strategy so that people put money and it's so easy once your strategy is very consistent, it's so easy to find investors because they are looking for people like you. And you end up having a fund of 5 million and taking, for example, 10 or 20% performance fee from the profit you make them. Which one you think you will make more money? Trading with $100,000 and keeping all the profit, or taking 20% profit of a fund of 5 million?
Taking 20% will feel good and nice.
Of course, with a peace of mind. And if you have a bad month, you don't have to worry. They are not worried. Nobody's worried because they know that on the long term you are still okay. So you don't have this psychological effect. And when I started to think like that and switching from own trading to fund management trading, my strategy became the best ever, and I became the most consistent ever.
Interesting. Right. We really appreciate your time. I think our time is almost up. We would bring this meeting to a close, and then we'll reschedule another meeting where we would take more of the questions, and we will also take more from you on risk management and all of that. So once again, we appreciate your time a lot, Marshall Trader.
It's my pleasure, brother. I really appreciate your effort and what you're doing for the African community. So anytime you need me, I am here. And I hope that one day we'll do more than that. We will meet face to face and we will meet your community back in Ghana.
Exactly. All right. Thanks a lot.
My pleasure. Have a nice weekend.
Thank you.
And we meet soon. Take care, brother.
So thanks everybody for coming through. I'll share this podcast.